and that brings me to the subject of this seminar, is to say the macro part. So the one side of the macro part that I will not talk about so much is the idea that the 2% inflation target should be a target for the Eurozone on average, which means that Germany should do more than 2% inflation. And whenever now you have demands in Germany for wage raise, the government should not do in Germany anything to prevent that, because you want 2% on average. So of course countries that are less competitive than Germany should have less than 2%, the southern countries in particular, but they need to breathe. And if Germany is doing a deflationary policy like they've been doing over the past years, everybody else is, you know, suffocating, and you have only recession elsewhere. So that's an idea. But the other idea, and I come now to the topic of my talk today, is to say, well, there is something very important that I've been doing. I don't know what I do is important, but I think this is important as a policy thing. Is the idea that counter-cyclical fiscal and monetary policies are very important for growth. And I will explain why. And it's very important, you know, to have automatic stabilizers. Is to say, you know, that you maintain, not only you have to maintain, you know, social transfers or whatever over the cycle, but you need also to maintain R&D expenses and anything which contributes to innovation and growth over the cycle. And for that, counter-cyclical policies are very important. And my recommendation was that, because Hollande was very much pushing the Eurobonds, and with a few friends, we told him, look, stop with this Eurobond thing. I mean, don't bother Mrs. Merkel. She will not do them unless you go much further in terms of being more federalist. So don't make the Eurobonds the main thing you push. Push for something much more important, which is the following. If you look at the fiscal compact, you know this agreement, the thing they agreed upon. The long-term objective is in structural terms. You say you have a public debt objective, but it's adjusted for the cycle. But the adjustment towards it, which was agreed upon, in fact, before they voted the compact, is in nominal terms. So we say 3% budget deficit in 2013, 2% in 2014, or whatever. Those are in nominal terms. They are not corrected for the cycle. And what you should obtain is that everything be corrected for the cycle. Because otherwise you run the risk of going pro-cyclical. You run the risk of penalizing a country just because it's in recession, not because the country didn't try to do the right things. And then you push into pro-cyclicality, and pro-cyclicality is bad for growth, and that's what I will argue now. So that's the thing that I think Hollande should be pushing for. Not the Eurobonds. The Eurobonds, we all agree it's for tomorrow, okay? And for the moment, should be pushing for this one thing. And now what I will do now is to present the research that I've done over the past 5-6 years now, which underlies this idea on the macro side that I pushed Hollande to push for. Voilà. That's my long introduction, and now I can start the seminar. Voilà. That's okay. So what I will present today is based on 2 papers. One is with David Emus and Elise Karoubi, and I think it came out, it's forthcoming, or it came out in Journal of Monetary Economics. And the second one is a paper with Fari and Karoubi. I said that here in progress, but now the paper has been submitted, so, but we don't know what will happen, so we don't know if the paper will make it or not. And that's on the monetary. So the first paper looks at the counter-cyclical fiscal policy, and the second paper the counter-cyclical monetary policy. And I will talk about the empirical parts in both papers. So the models, you can look in the paper. I will talk to you about the ideas and the empirics. Okay? So, the motivation for this research is the fact that, you know, usually when you look at the textbooks, you have 2 parts. When you take a intermediate macro textbook, you have a part on growth, and growth usually either is determined by nothing important, and that's the solo model. You just say, you know, there is no growth in the long run of per capita GDP, or you have models that will tell you that, you know, growth in the long run depends on institutions, you know, on protection of property rights or whatever, but not so much on fiscal and monetary policy. And in fact, so you would say competition is good for growth, financial development is good for growth, education is important, institutions are important, trade openness, blah, 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 but they will not talk about monetary fiscal policy. But then there's been work, for example, by Rame and Rame in the mid-90s. They have an AER paper, 1995, where they show a negative correlation between macroeconomic volatility and growth. And they show that this correlation is more pronounced for non-OECD countries and for OECD countries. But still, they find this negative correlation. On cross-country, but they do cross-country panel regression. And that's what, no, cross-country regression, that's what they do, Ramen. So it's kind of very macro regression. Nowadays, you cannot publish a paper in a top 5 journal. It's very difficult if you only do cross-country regression. I mean, it's very, you have to fight very hard for that. Now you need more micro things. But and what I did subsequent work that came also in Journal of Monetary Economics with Banerjee, Manova, and Angeletos. I think Marios was here last week or something, so you know Marios. And we have a paper that says that in fact the negative correlation between volatility and growth is more negative in countries that have lower financial development. That could explain why in Rame you have a more negative correlation in non-OECD countries than in OECD countries, that presumably the non-OECD countries have lower level of financial development. How we measure financial development there? It's done at country level by bank credit over GDP, by the Levin. You know the work of Levin, King, Levin, and co-authors. So we were just using Levin measures of financial development at country level. Okay, so that was the starting point. And also in that paper we saw that kind of structural investment seemed to be bigger when you had less volatility. That volatility was also bad not only for growth, but also for long-term structural investments. And we didn't have very good R&D data there. But so since then I've been working on this idea to try to understand why is it that you have this result that volatility is more negatively correlated with growth, particularly in a credit-constrained environment. And the intuition, and I don't want to develop a model there, but is to say the following, is to say what happens is that firms face credit constraints, and when they face credit constraints, typically, you are a firm, that's the story, you are a firm, and you have the short-run profit that depends on your productivity shock. And also what may happen is that the ceiling may fall on your head. You may have what we call a liquidity shock. So, for example, Stepan is lucky, the fall will not fall on his head, but I'm unlucky, the ceiling will fall on my head, okay? So that's I call a liquidity shock. This one is idiosyncratic. And the problem is that if the ceiling falls on my head during a recession period, I may have to cut R&D. You see what I mean? R&D is typically something you have to maintain over the long run. But if the ceiling falls on my head at a time where I have low cash flow, I have to pay for the ceiling, and there is not enough borrowing capacity based on the cash flow to also pay for R&D or for training. And then I have to cut on R&D. But that's bad for growth. And if I anticipate that whenever there is a recession, I will have to cut on R&D, I may not even engage in R&D to start with, because R&D is something you have to pursue in the long run. Do you see what I mean? So that's why more volatility is bad for R&D and growth, because with more volatility, typically you cut R&D in good times, and it's not that you increase it so much in bad times, it's not that you increase it so much in good times, because in good times essentially you are not credit constrained. So if I were in a world without credit constraints, I should be careful here, I could always borrow up to the net present value of my profits. You see, if I had whether you are in bad time or good time, if the ceiling falls on your head, it's no problem, because you could always borrow up to the net present value of all your future flow profits. So whether you're currently in good times or bad times, you would have the same borrowing capacity. Do you see what I mean? And you would always have enough to both repair your ceiling and keep investing in R&D. But when you have credit market imperfection, you can only borrow a multiple of your cash flow. When your cash flow is low, you can borrow less. And therefore, when the ceiling falls on your head, you are stuck. You see, you cannot also finance your R&D expenses. And that's why, the more credit constrained you are, the more damaging for R&D and therefore for growth it is to have higher volatility. Do you follow this reasoning? Do you understand? That's the intuition. I could put that in math, but I won't do it. But that's the notion. So what I did with this idea is that we tested this idea with Banerjee and co-authors and Angeletos on cross-country data. Then I tested that. When I do usually one thing, I try various papers on the same topic. So people think I write the same paper 10 times. But in fact, we're looking at different aspects. So another thing we did was to do it on French data. So what we did on French data was to, in fact, look at firm level data. And what's very nice when you have firm level data, so that, I don't know, maybe you could do something like that with Czech data, because we use the Bank of France. What the Bank of France had is that it had a list. You know, whenever firms don't repay their trade creditors, firms, they are put on a blacklist. And then banks don't lend to these firms. They say, this guy is not reliable, I don't lend to them. And those are credit constrained firms. So you can use the fact of being put on the blacklist as an instrument for credit constraints. So you have a firm level measure of credit constraints. And what we found is that firms that were more credit constrained, they had more pro-cyclical R&D. That means they had to cut R&D more in recession than firms that were not credit constrained. In fact, firms that are not credit constrained, R&D is counter-cyclical. And you know why it's counter-cyclical? Because you do typically more R&D in period where you don't have so much, you know, suppose you have a baker, for example, you can either produce bread or do work on your oven. When do you do work on your oven? But in times where you have less demand for your bread, because when you have high demand for your bread, the priority is to produce your bread. So when you have no credit constraints, typically R&D and this kind of or reorganization of firms is counter-cyclical. But when you have more credit constraints, this kind of expenses are more pro-cyclical. And on average, they are less. Because you cut them more in recession than you increase them in expansion. Because in recession, the credit constraint is very binding, whether in expansion it's not, so you have an asymmetry. You understand? You follow what I said? Or I should put that on the blackboard, on the whiteboard? And so that's the reason why, so the reason there is to say, typically, you would like to have counter-cyclical policies. Now that you know that volatility is more damaging for R&D and this kind of investment in more credit-constrained firms, you would think that when you have countries or sectors that are more credit-constrained, to have a more counter-cyclical fiscal policy where the state borrows more in recessions and repay in expansion would be good, because the state would do what the credit market cannot do. The state would lend to firms, or you would have public commands. You see, you would have public, you would maintain public, procurement, of goods. And so what I looked at is to say, well, I want to look at the effect of the cyclicality of fiscal policy, but also monetary policy, and that's why I get to the to the central bank, is that I say, interest rate. I will look at, so the first part of my talk, I will look at fiscal policy, and the second part of my talk, I will look at monetary policy, interest rate, and I will show that both the counter-cyclicality of them is more growth enhancing when you have more credit constraint or liquidity constraint sectors. That's what I will do. Okay, so reducing aggregate volatility enhances growth more in firms that are more credit constrained, in part because firms are more credit constrained in low states. This growth enhancing effect should be particularly strong and significant in low states. This suggests a role for counter-cyclical fiscal and monetary policy to enhance R&D and growth. So I told you that I had cross-country analysis, then I looked for France at firm level analysis. Here I will choose at cross-country, cross-sector level. And because you have various problems when you try to do that. You see the problem, if you want now to say, I would like to test for the effect of counter-cyclicality of policy on the problem is that if you want to do that cross-country, it's difficult because the cyclicality of fiscal policy in a country is like a country fixed effect. So it's very hard to do that and to control for the country fixed effect. You see what I mean? Because in a sense, they are the same. So you would like to be able to separate the country fixed effect from the counter-cyclicality parameter. And it's very hard to do in a cross-country panel. I have a paper that came out in Macro Annual NBER where we try to do that by having windows, by moving doing a time-varying measure of counter-cyclicality and having a kind of method of windows. But that's the best we could do. But I think it's better the way we do here, using sectoral data. Another problem you face when you try to do this test is the reverse causality. Suppose you find a positive correlation between counter-cyclical fiscal or monetary policy and growth. It may reflect the reverse causality from growth to counter-cyclical, because typically a faster-growing country would be easier for the faster-growing to borrow in recession, to repay in expansion. So you don't know whether you're capturing one causality, or from the policy to the growth, or from the growth to the policy. And here we want to make sure that we capture the causality from the policy to the growth. Okay? So for those reasons, the solution we use is Rajan-Zingales. Who knows Rajan-Zingales 98? Okay. Who doesn't know Rajan-Zingales 98? Okay, so Rajan-Zingales, what they did, Rajan-Zingales, they were interested. So Rajan-Zingales, they were interested, I think it's AR, I think 1998, or JPE, I don't know. So they were interested in testing the effect of financial development on growth. And so the way they did is to say, look, what I will do is to say, look, I will take sectors in countries other than the US, and I will look at the equivalent sector in the US. Some sectors are prone to be credit constrained. So for example, those who depend more on external finance in the US are sectors that are prone to be credit constrained. And what I will show is that financial development in a country is more likely to be good for those sectors whose equivalent in the US is relying more on external finance. That's what they tried to show. So they wanted to look at the effect of financial development in Czech Republic, measures, for example, by credit over GDP, bank credit over GDP, on growth in Czech Republic. But what I want to show that really there is a credit constraint phenomena there, I want to show that the effect is stronger for an industry in the Czech Republic whose analog in the US relies more on external finance. So that gives you a sense that there is a causality from credit constraint to growth. You see what I mean? Because there is no effect of the Czech growth on the degree of credit constraint of the sector in the US. You see what I mean? And that's how they did. And so what I will do here is to get the same methodology as Rajan-Zingales to look at the effect of the cyclicality of the monetary or fiscal policy on the growth process. Okay? So how will I do that? That's my second stage equation. So my second stage, I have a pointer there. I have do I have a pointer? Yeah, this is. No, this is not. I was wondering whether I have something that's no problem. If oh no, I do have. Yes, here. Yes. Fantastic. Yeah, that's you see how much technology frontier I am. Okay. So the methodology, I need to move a bit. Okay. Okay. So what I do there? So you take you take an industry. Suppose you are in Czech Republic, and you take a sector in the Czech Republic. So the sector you call it I, and the Czech Republic is C. Okay, for Czech Republic, that's good. So you take a period of 20-25 years. Okay. And you regress the growth rate. So the growth rate can be value-added growth in the industry I in country C, so it's the average annual growth, okay? Or it's the average labor productivity growth, okay? And we will look at both type of growth. And you look at the average growth of the of GDP in the industry, or productivity in the industry, and you regress it on the industry fixed effect, alpha I. Now I can put the country fixed effect, beta C, and then I regress on initial income, in industry I in country C at the beginning of the period. And then that's the things I'm interested in, is the interaction between the measure of fiscal policy countercyclicality and the credit constraint. So in fact, that's why Rajan-Zingales SC is an industry characteristic. It will be financial dependence or asset tangibility in the same industry in the US. You see what I mean? I will look at the equivalent industry in the US, and I will say, is this industry prone to be credit constrained? Well, it's more prone to be credit constrained if it's either more dependent on external finance in the US, or if it has lower asset tangibility. You know what asset tangibility is? If I have a sector where you have a lot of machines, there I can use the machines as collateral. But if I am in a sector where I have essentially goodwill or immaterial capital, that's a low asset tangibility. It's much harder to borrow. And the idea is that the sectors where credit constraint is most binding is those where you have, low asset tangibility. Or it's bad for you. I disappear from your. So at least it would be good if half of the talk I am on the picture. Okay. So that's the variable that measures credit constraint, and I interact that with the degree of fiscal policy countercyclicality in country C, which I will tell you in a moment how I derive it. And what I want to explain is that this gamma is positive and significant. The more credit constrained you are, the more financially dependent on external finance or the lower asset tangibility. So when it's true, when I use asset tangibility, it will be a negative gamma because asset tangibility is a reverse measure of credit constraint. I will have a more, you see, growth is more and more enhanced by FPC than I have either a high dependence on external finance or low asset tangibility. And that's what I will be testing, okay? That's the main regression equation. And I use OECD countries, and I take 45 manufacturing industries across 17 OECD countries, which are all the OECD countries except the US, because I use the Rajan-Zingales methodology. So that makes me a lot of observations. 45 industries across 17 countries. So that makes enough observations. Okay? So that's my main regression. Yeah. So now, so there are good reasons to believe that the effect of this interaction is exogenous to the growth variable, because SCI pertains to industries in the US, whereas the growth variable involves industry in countries other than the US. And furthermore, the fiscal policy countercyclicality is measured at macro level, whereas GIC is measured at industry level. So that makes you confident. I will still have an instrumentation section later on, but this shows you that you have, you know, these are good. That was the idea that Rajan-Zingales wanted to tell you. It was a way to get at the causality without using instrumentation, by taking the analog of the industry in the US. That's what's the smart thing that they did. Okay. So now here is the auxiliary equation. So that for fiscal policy countercyclicality, what I do, I will push this a bit, because I won't need that much, but not more than this, otherwise it will be a disaster. There what I do is now the problem is to compute the fiscal policy countercyclicality. What is the countercyclicality of fiscal policy? Is the extent to which you run a deficit in a recession and you reduce your deficit in an expansion. So how you know that? Well, you regress, you know, the fiscal balance, or the primary fiscal balance, where you take out payment to and from the government. You regress that, or you could regress government revenues or government expenditure as a fraction of GDP, over the GDP gap. The GDP gap is the difference between the actual GDP and the trend GDP divided by the trend GDP. Okay, so that's the GDP gap. So when you have a positive gap, you are in an expansion. When you have a negative gap, you are in a recession. You are below trend. And so what you would like, when is it that the country is counter-cyclical? But it's when you have a bigger fiscal balance, a better fiscal balance, in an expansion. So you would like a positive FPC coefficient. The more positive it is, the more counter-cyclical you are. The more negative it is, the more pro-cyclical you are. You see? So that's what you do. And what you do, you can, of course, start this equation, but you can use a more sophisticated version. For example, if you read Barrow, Barrow has a paper on a 1979 paper on public debt, I think in the QJE, or in the JPE, and there it's a bit more sophisticated. It's the same equation as here, but you control for the initial debt and also for the fiscal policy countercyclicality previous period. But it's still the same kind of equation. And you again derive, and I will use that as well to just show robustness to using more traditional equation. That's my auxiliary. Once I get, so I regress that over the whole period of 25 years, and I get the FPC coefficient. Once I have the FPC coefficient, that's what I use when I do my second stage equation.
Sorry, did the referees ask you how do you measure gap? This is metaphysical category.
Or I take the measure of gap that are usually measured. It's the usual measure of GDP gap. You can use filters as well, you know, the HP filter, but you know, we did the usual thing. So we try various things, which are the usual thing. So we did not innovate there, we took the standard. We tried various and it worked the same way. So that's what we did. Usually when there is controversy, we tried everything. That's why, you know, but not everything, but 2 or 3 main things. Voilà, not everything that is absurd. I mean, the 2 main things, and we showed that, you know, at least we don't want to take argument. We didn't take sides, and it was robust to that. So that's the auxiliary equation. So the data, you use industry level data from EU claims. So EU claims, it's a database, which is very interesting, which is cross-industry, cross-OECD country. I'm losing Stepan. So that's good, this pointer. No? That's a...
Go find it, please.
No, I'm joking. Sorry. It's much better. You know, when I was at school, the way it's French school it works is that the guy, the teacher will choke at you. So that's much better than
So did the referees ask you?
You know, I could throw her. Sorry.
So I'm going to throw something back at you. So did the referees ask you?
Because I will regret having I promise. You see, that's a device for never use the pointer again. Okay.
Did they ask you?
Tough question coming up. Yes.
Simple question. Did they ask you to keep in the main interaction between the financial development and the external financial dependence? Because usually in the corporate finance literature, when you add another interaction, they ask you to.
Yes. And you will see that we do that later on. And so we do that, and it's still robust. You will see.
And is there enough evidence over your time span that these industries are indeed synchronized in terms of growth? Right, because this whole
this whole methodology works because you have the same ranking across countries and you
same ranking and the growth opportunities. So it's usually you know.
But the same ranking, you have the same ranking around. That's the key. Voilà. It's not so bad. I can point you again. Okay. Okay. So the financial dependence data come from, Rajan Zingales, and there is this Radats has an updated version of it, and asset tangibility is from Braun and Larain in the paper in 2005, and the main macro variable are from OECD and World Bank data. So that's the data that we use, and now I will start showing you pictures because let's have fun a bit. So now I show you results from the first stage, okay? So I want to show you the FPC coefficient for various countries C. Okay, so I do this regression for different type of countries. And let's see what we get. So those are the countries. So you see the good guys are those, of course, the more positive FPC, and the blue line shows the value of the coefficient, and this is the 10% interval, the confidence interval, you see, the red, okay? Now, the good guys are Sweden. Sweden is very good. Denmark, Finland, Great Britain is not too bad. Japan, Netherlands, those guys are good. And Great Britain is good. France is okay. I mean, on fiscal, not great. And the bad guys are Greece and Italy. Okay? So those are pro-cyclical. Now, it's very interesting to understand why some countries are pro-cyclical. And there have been very interesting papers. So, for example, I encourage you to read a paper by Alesina and Tabellini, where they show that the mixture of democracy and corruption leads you to be more pro-cyclical. And the reason is that suppose you are a corrupt government, you hide things, you know. If you start saying in good times, I want to put the money aside for the bad times, you will not be voted again, because people will believe that in fact you are not doing that, you are putting money in your pocket, because you are corrupt as well, and they won't vote for you. And because they want you to vote for them, they will give out the money. But you don't need to be that corrupt. Even Jospin in France in 2002, right before he lost the election, so he could have as well done the right thing, and he would not have changed the outcome. There was the debate on what to do with the surplus money. And of course there was huge pressure to distribute the surplus money. And he was forced to do it at the end, because he had an upcoming election, which he lost anyway. So that's a good illustration of the person Tabellini, Alesina Tabellini. So that's an interesting thing to look. Here you can look in terms of primary deficit, and it's very similar. It's even bigger. You see, Greece and Italy are even more pro-cyclical, and France is doing worse. And Denmark, Sweden are doing very well. So that's an interesting thing. And you may want to understand why they do well. Or you could say it's because Sweden has an independent central bank, and I think Denmark, what is Denmark? Denmark also, no? They're not in the euro. Exactly. So of course that helps, of course. Huh? But Finland is not doing bad, and they are in the euros. You see, that's so some people manage, even though they are in the euro. Netherlands is in the eurozone, and they're doing well. So that's interesting to understand. So now you can try to have covariates. So what's interesting here is that here we try to use cross-country regression to just have a suggestion of possible covariates. And it will be also important to have the covariates, because you might say, well, in fact, what you call counter-cyclical fiscal policy might be the effect of these covariates, in fact, and not so much the effect of counter-cyclical fiscal policy. What we'd like to do is to control for the interaction between financial development of the sector and the covariates, and still see if you get the effect of counter-cyclicality. So that's what I'm doing here. I'm trying to exhibit so covariate. So here it's government size. We see that countries that have average fiscal expenditure to GDP tend to have more counter-cyclical policy. So why is that? I believe that automatic stabilizers, typically countries where you have higher automatic stabilizers, tend to be bigger countries, and that could be an issue, okay? But I'm not taking sides of what you might think of other explanation. I'm totally open. That's one I think about. I just show you that there is this correlation, okay? Another one is fiscal discipline. So that's very interesting. Countries that show higher fiscal discipline, that mean higher total balance per GDP, divided by GDP on average, are more counter-cyclical. And that's very much easy to believe because, you know, when you have bigger fiscal discipline, it's easier for you to borrow in bad times as a government, to repay in good times, because people know that you will not default, you see what I mean? And so you can borrow in bad times at lower rates and repay. So that's why, the way, when you talk to Anders Borg, who is the finance minister of Sweden, but you know, he was started by Göran Persson, who was the Social Democrat leader there, they realized that it was very crucial after the banking crisis of the 90s, it was very important for them to achieve fiscal balance, not alone, because it was a way for them to conduct more counter-cyclical policies. And that's a big lesson. There is a big gain to have more balanced budget because you can conduct more counter-cyclical policies. And that's what I explained also in France. It's not only because you have Mrs. Merkel with a whip there telling you should do it, or the markets doing that. It's because it's good for you to do it, to have more counter-cyclical policies. Okay, so that's an important thing to have. Now here is monetary inflation. Countries that have lower inflation also have more counter-cyclical fiscal policy. And you might think why as well, because if you have lower inflation, it's easier to borrow in bad times because you know there is less expropriation to the lender later on, you see, because the inflation is lower. So those things are good to have in mind, in fact. And in fact, what's interesting is that, for example, Great Britain, when they introduced inflation target and the new way to monitor inflation target, they became more counter-cyclical. So that really captures the story. So those will be covariates, those will be controls when I do my second stage regression, okay?
Philippe, this is related to the Corsetti et al. Story that if you have more sovereign risk, then you have less the ability to be pro-cyclical and the counter-cyclical in the fiscal policy because the sovereign risk spread goes to the private spread.
Yeah, very much relates to that, absolutely, absolutely. So now I look at the results from the second stage. So now I look at this equation, at this regression. So now I look at the gamma, okay? And so the basic regression, I regress, GIC here is real value added growth, so average growth in value added over the period that I take the period 1980-2005, 25-year period. And that's the coefficient gamma. So here I interact between financial dependence. So what is financial dependence? Is the extent to which the equivalent sector in the US relies on external finance instead of retained earnings to finance its investment, okay? And you see that there is a positive significant interaction between the extent to which the equivalent sector in the US is financially dependent on external finance and the counter-cyclicality of the fiscal policy, which is the coefficient that I derived from my first iteration. Yes?
You would improve efficiency by weighting the second stage regression with 1 over the variance, the standard error squared from the auxiliary regression, because you actually have, you know how much measurement error there is in your calculation.
Yeah, but I deal with that later. I'll show you so we have a thing, but we'll show you that for the monetary, and that's how we did. We did a kind of bootstrapping, okay? Fine, so it's not, yeah, you can wait for the
minimum distance estimation, and just weight by the inverse of the variance of the coefficient from the first stage.
Yeah, because we did something a bit different, which is, I will tell you what we did, which is a bit to deal with this problem. But, so now here we do the same, where in the first, the auxiliary equation, I could look at the balance. Here is the fiscal balance divided by real GDP or by potential GDP, by the GDP corrected for the cycle, to make sure that what you are capturing is not just variation in GDP, but really the policy. And when you do that, you get, and when you derive FPC this way, and you put it back in the second stage, you get a very similar figure. Okay? So and then it's, when I take, instead of total fiscal balance, I take the primary fiscal balance. divided by actual GDP or or potential GDP, you get very much. So the first 4 columns are doing these things, and it's always the external finance and the extent to which and the degree of counter-cyclicality of the policy measured, by the various version of the auxiliary of ways to implement the auxiliary equation. You see? So either using total balance over actual GDP, or total balance over potential GDP, or primary balance over actual GDP, or primary balance divided by potential GDP. So each time you find that you have a significant positive coefficient. And here is the one I have negative, because here I am interacting fiscal policy counter-cyclicality with asset tangibility. But I know that asset tangibility is a reverse measure of credit constraint. That's why I'm getting negative. And you see, those are very significant and positive. They are very significant coefficients. So you see that indeed, when you have more credit constrained sectors, or more prone to be credit constrained sectors, it makes a big difference to growth to have more counter-cyclical fiscal policy. Okay, so that's the finding here. Okay, so now you can put, instead of true growth, you can put productivity growth, and you find very similar thing. So it mainly works for productivity growth. In fact, you enhance mainly productivity growth, which hints at my story on R&D and other type of investment, is that in fact, what you do when you have more counter-cyclical fiscal policy is you help firms maintain growth-enhancing investment over the business cycle. So what we do next is to look at alternative fiscal policy measure. So what we did, remember, we used the Barrow, here I will use this equation, which is more sophisticated rather than this one. And we use various versions of it, gross debt, net debt, etc. And that's what we do here. And we find that, you find similar measures. So you see that, so then that's when you take the gross liability or the net liability and measures, and you take the Barrow equation, you find very similar regressions as when you take the simple auxiliary equation. So that's good. Barrow is happy then, and that's when you do productivity growth similarly. So now you want to know, in my story, remember that I said, what is it good to have counter-cyclical policies? Because it will help them particularly maintain R&D in recessions. In expansion is not big deal. Where they have to cut on R&D is typically in recessions. Those firms that face a liquidity shock in recession have to cut their R&D. In expansion, they don't have to cut R&D. So it's really in low level. So what we do here is that we run the equations, but running them only for a country time period, country time pairs, for which the gap is below the median gap. So for each country, you know what the median of the gap is. And you take the years for which the gap were below the median and years for which the year were above the median. And you restrict your regressions to country years where the gap is above the median or below the median. And so when you restrict attention to country years that correspond to gap below the median, so that's what I call a low, you find that the coefficients are higher in absolute value than in the basic regression. So here you see bigger coefficient than you have here, for example, than you have here. The basic regression was here, you see, and now 6, 6, 6, 4, 13. Look now, it's a much bigger, all the coefficients are bigger in absolute values. So it means that really the low, whereas if I now restrict to time period where the gap is above the median gap, you find, smaller coefficients and not even significant. The interactions now between asset tangibility and counter-cyclicality of policy even becomes non-significant anymore. So it's really the low states that drive this. It's really the intuition I was giving you. Counter-cyclical policies stimulate particularly in the bad states. You see what I mean? There is really an asymmetry between the bad state and the good state. Why? Because you're much more credit constrained. The credit constraint is much more binding in the bad state than it is in the good state. That's all. That's why. Okay, so now so what happens here, this table shows you that in fact, when I control for the interaction between fiscal policy, counter-cyclicality and financial dependence, the interaction between volatility and financial dependence becomes insignificant. That means that you eliminated the effects of volatility on growth in more credit-constrained sector by having the more counter-cyclical fiscal policy. So it really shows that, in fact, it improves the growth because it eliminates the negative correlations that I had between volatility and growth in more credit-constrained environment. That's what it did. I eliminated the volatility, and that's why you see, the volatility on top of my counter-cyclical, if I know how to deal with volatility, in itself, there is nothing bad with volatility, if I know how to deal with it. That's what it says. Okay? So now I have other stories. Remember that I had my covariates. Remember that I said, you know, bigger governments tend to be more counter-cyclical. So it could be that when I show the interaction between counter-cyclical fiscal policy and credit constraint, I was in fact showing the interaction between size of government and when I was saying, you know, remember that I showed that governments that have bigger fiscal discipline tend to be more counter-cyclical. When I show the negative, the correlation, you know, the interaction effect between counter-cyclical fiscal policy and degree of credit constraint, I'm in fact maybe just capturing the interaction between fiscal discipline and the degree of financial dependence. You see what I mean? And inflation, remember that I showed that lower inflation country corresponded to higher counter-cyclicality. Maybe I was just capturing the interaction between the external asset tangibility or external financial dependence and the level of inflation. So what I do here is that I control for all of those interactions. So here you control for inflation and asset tangibility. Here you control for size of government and asset tangibility. Here you control for fiscal balance to fiscal discipline, asset tangibility. You see what I mean? Here you control for financial development and asset, interacted with asset tangibility. And you see when you put all these interactions, it doesn't change the coefficient. The coefficient remains essentially the same. You see what I mean? And the other are, except for financial deposit to GDP, which is significant, but it does not, introducing it doesn't change the coefficient, the effect of the interaction between counter-cyclical fiscal policy. It doesn't mean that those things don't matter. But if they matter through their effect on counter-cyclicality. They don't have independent effects. You see what I mean? It could mean that they matter to be more financially developed, could matter, but it matters essentially through, or lower inflation or fiscal discipline could matter, but if it matters, it's only because it makes you more counter-cyclical. It doesn't have an independent effect. That's what's important. Yes?
So I understand that you have these French firm-level regressions that look at the reaction of R&D to credit constraints.
Yeah.
But one could imagine kind of a triple diff and diff and diff,
yeah,
where you would identify industries not only by how dependent they are on external finance, but you could take U.S. firm-level data, where you can assume that credit markets are as good as they get, and run a within industry regression, which would predict how sensitive company performance is to R&D spending, right? And that way you would have an industry-specific coefficient that would tell you how important R&D is for growth.
So what I'm trying to
interact that here to support your story about this is how growth.
One thing we've tried to do in that direction is to separate between high-tech and low-tech industries, and it's more important in high-tech. But you're right, we could do that. The problem is that we don't have cross-firm. We don't have cross-firm. You see, I mean, that's the difficulty. We don't have. Now you have the Amadeus data set, but at the time we didn't have the cross-firm. Here it's at sectoral level. We didn't have the firm level.
US panel data.
For cross-country, you see what I mean?
No, but this would be just US.
Or for the US.
Within industries over.
Okay, where firms are. So you take the segment.
Data, and you identify how firm performance reacts to R&D within industries over.
Oh, yes, okay. And you take those ones where they react in the US. Then you could have a triple. That's a good idea. That's a good idea. That we haven't tried. Absolutely. So that's with the real value added, and that's with labor productivity growth. And again, you see that none of the covariates here comes, at least the financial development could come. You see that none of the alternative comes significant when you look at labor productivity. None of the covariates interacted with financial dependence or asset tangibility comes significant, and the value remains the same for the interaction between fiscal policy, counter-cyclicality, and the credit constraint of the sector, you see. So that's the other stories. Then we instrument. So you remember the problem we had is that you see the MPC thing. You know, when we derive this coefficient is a generated regressor. You see. So what to deal with that? We did two things. We instrument. So one thing we do is an instrument, and we use essentially legal and political variables to instrument, and that works as an instrument. I'm not extremely fond of legal origins and these kind of things, but at least it works as instruments. Okay. I think the better thing we did is a bootstrapping, where we said, it's a generated regressor, but suppose that it comes from a normal distribution, have draws from it, and for each draw, do the second stage, and then average of the gammas from the second stage, and you get 2000 second stage, and you do the average, okay, and you find exactly the same coefficient. And that's how we dealt with the generated regressor thing, which is a way to get a bit at your variance problem that you were mentioning before. So we did the bootstrap and the instrumentation. That's why we try to get at the problem of generated regressor in this. I don't know if we can do much better than that. Okay, so now the economic magnitude. You may want to ask, how big these effects are. So what Rajan Zingales did is to say, suppose you go from a country which is the lower quartile of countries in terms of financial development and lower quartiles in terms of financial dependence of the sector in the US, to the country with this higher quartile in terms of financial development and higher quartile of the sector in terms of the financial dependence of in the US. And they were getting about 1%, one percentage point, effect. And we did exactly the similar here. We say, suppose you go from a sector which is lower quartile in terms of financial dependence, or higher quartile in terms of asset tangibility, in a country which is lower quartile fiscal policy countercyclical, and you move to that from both having the sector in the higher quartile in terms of financial dependence and higher quartile in terms of the country countercyclicality. How much you gain? And we find between 2 percentage points. You see what I mean? We get a gross gain of 2%. So it's very much in the same order of magnitude as Rajan Zingales, which made us happy, because if you have found 200% or 20%, it would look unrealistic. And we have found 0.002, we wouldn't be happy either. So it's effects of the same magnitude as the Rajan Zingales effect. So those are sizable effects and yet believable effects. So now what we do fiscal revenue and expenditure, because when you have the fiscal balance, there is both revenue side and expenditure side, and we show that both are important. You want both to be countercyclical for the growth. Both matter. So here is the effect, the interaction with fiscal revenues, and then the interaction with fiscal expenditure. Of course, the other one should be with a negative. And you see that both are comparable, both play a similar role, and they have very similar coefficients actually.
How do you reconcile that with Alessina's argument that cutting revenues matters more than increasing expenditures?
But I don't know, he has to tell her. Ask him the question. How does he reconcile with our finding? He doesn't look at growth. So I don't know what he did. Did he do growth regression?
Yeah.
Yeah, I should ask Alessina. Yeah, because that's not what we seem to find here. Alors now the industry R&D, I told you that it was R&D that mattered, and so here instead of regressing growth, we regress R&D. And what we find is that R&D reacts positively, more positively to more counter-cyclical policy in sectors whose equivalent in the US are more credit constrained. And so R&D plays a role. You see, R&D reacts exactly the way we said. Average R&D is enhanced by having more counter-cyclical policies. So now that concludes this part. And so far, stabilizing fiscal policy raises long-term industry growth, and the more so in industry with higher financial dependence or lower asset tangibility. This effect is particularly driven by what happens in low states. It is economically significant. Next step, apply the same kind to monetary policy. So now I move to the second part of the talk. How long do I have left?
Half an hour.
Okay, so that's more than I need.
You can talk faster, Philippe, I know.
Absolutely, I always, so let me just, yeah, I'm losing people, full screen mode. Okay, so now I get okay. So monetary policy, liquidity and growth. So there the idea, I will pass the model. You don't want a model, okay? I don't think you want, I don't have time. And I get to the main prediction. So I will say, I will use exactly the same methodology. But what I will do is that I will say, look, what is my intuition? You want to help firms borrow in recession to be able to finance R&D. What do? You lower interest rates. You see what I mean? So that's what you want. You want them to face lower real short-term interest rate in recession and higher short-term interest rate in expansion. So now what I will do is exactly the same exercise as before. I have my second stage where I will regress growth in industry I in country C on the industry fixed effect, the country fixed effect, initial income, but now is the interaction between the degree of credit or liquidity constraints, and now I'll be a bit more, speak more about that, of the equivalent sector in the US, and the degree of monetary policy countercyclicality. And I will tell you how I define monetary policy countercyclicality. So now the SCI will be either the credit constraint, it will be either, because for monetary policy, it's not only whether you are credit constrained, it's also whether you are liquidity constrained. So what is liquidity constraint? Take a sector who has a high labor cost to sale ratio. You have to pay the wages every month. So you need a liquidity. Take a sector who has high inventory to sales ratio. You need to replenish your inventories. You need liquidity. You see what I mean? So that even if you are solvent, you see what I mean? You suffer. You may have to cut R&D if you have a liquidity shock. You see what I mean? Because you are liquidity constrained. So I will look not only at credit constraint, at things like, asset eligibility or external finance, but I will look at things which affect the liquidity of the sector. The proneness to be liquidity constrained. I could look also at something called cash conversion cycle. You know how long it takes to get back to the cash. And that's very much related to the to inventory to sales ratio. It's very similar. They are essentially collinear. So I didn't put the cash conversion cycle, but it's exactly the same thing. So that's a very important measure. You have sectors that are not really credit constrained, but they are highly liquidity constrained. And for those sectors, it makes a big difference to have a more counter-cyclical monetary policy. So let me show you. So that's the second stage, okay? And now let me tell you how I derive the monetary policy counter-cyclicality. So I do like this. I look at real short-term interest rate. And I regress real short-term interest rate on the GDP gap. And whenever you have, and the coefficient is the counter-cyclicality of your monetary policy. If you have higher real short-term interest rate in booms compared to slumps, which would be an MPC coefficient positive, you have a more counter-cyclical monetary policy. Okay? Alors, I do it this way, but you can have more sophisticated equations. For example, this one, where you control for the persistence of monetary policy. This one where you control for forward monetary policy. And the one where you regress only taking years where GDP gap is above the median, which is the upturn, and the years where the GDP gap is below the median, which is downturn. Again, I want to look if there is asymmetry, if it matters more in recession and in booms to have a more counter-cyclical monetary policy. Okay? So in fact, this is a Taylor rule, in fact. You've heard about the Taylor rule. In fact, you do the Taylor rule like this. Because the real short-term interest rate, as you know, is nominal short-term interest rate minus inflation rate. Okay? So what you can do is to say, I decompose into the nominal, the Taylor rule, which shows how the nominal short-term interest rate adjusts to the gap, controlling for inflation. And then you have the Philippe curve that shows how inflation adjust to the gap and the previous term inflation. And so you can decompose the auxiliary equation into a Taylor rule and a Philippe curve. And there is one time where we decompose because we want to see how much, you look at the effect of counter-cyclicality of real short-term interest rate. It has two components. It has the nominal short-term interest rate and the inflation rate. Which one is more important that it be counter-cyclical? And we find that both matter. You see, it doesn't that it's both the nominal and the inflation component. You want them to be cyclical. No. Okay, so that's my thing. So data are the same as before. And now let me show you countries in terms of cyclicality of monetary policy. So here, who is good guy? So who are the good guys? Sweden again, Great Britain. Of course, they have independent central banks, so that helps. But also what's interesting is that Germany is not bad. So it means that in fact it's a way to say that the central bank policy is more tailored to Germany and countries like that. And for example, Portugal is suffering from the euro. So that's a way already to say that Portugal is, I don't say that they should exit the euro, but they suffer a lot from the euro because the euro does not adjust much to the needs of Portugal, you see. And hello. So that's the interesting thing. So because it tells you that even within the eurozone, you have a big heterogeneity on whether the monetary policy, the real short-term interest rate, are adjusted or not to the cycle of the country. That's in itself very interesting to look at this table. and to see, for example, that Portugal, so here Spain, Finland here is not doing too well, and Portugal is doing not well. You see, Italy barely, and voilà. That's an interesting table. That's in terms of, and that's the nominal short-term interest rate to output gap, and then you see that the values are Spain and Portugal. Spain and Portugal are really not well adjusted, whereas France is doing fine. Great Britain, Germany should be doing fine. Where is Germany here? Germany, I don't know where it is, but it's somewhere.
Fifth one. You have it in
Deutschland.
German.
Huh? Deutschland, exactly. Okay, so that's the first stage. Now you can look again at covariates. Remember, I can do exactly what I did with the fiscal policy. And I can say, for example, here, first you can show that countries that have more counter-cyclicality of monetary policy are less volatile macroeconomic. So it helps, it suggests that it helps solve the macroeconomic volatility to have more counter-cyclical monetary policy. Here, the cost of capital, countries that are tighter in terms of cost of capital on average have more counter-cyclical monetary policy. So that's a bit the equivalent of when we showed that countries that had bigger fiscal discipline were more counter-cyclical fiscally. The same is true in monetary terms. So here it's short-term cost of capital, inflation. Countries with lower inflation have more counter-cyclical monetary policy. And the long-run fiscal, that's the main covariate. So now I show the second stage. And here I interact, I regress growth interacted on the cyclicality of monetary policy, interacted with financial dependence and asset tangibility. You see that it's very positive here and very negative here, again, because asset tangibility is a reverse measure of credit constraint. So the more the equivalent sector in the US is prone to be credit constrained, so the more your growth in your sector benefits from a counter-cyclical real short-term interest rate. Okay, you want the short-term interest rate to be lower in recession, higher in booms, in order to help firms maintain R&D expenses. Okay, so that's true for monetary policy. That's the now. Here what I show is the interaction with the inventories to sales and labor cost to sales. So here I'm looking at the interaction between cyclicality of monetary policy and the extent to which the firms in the sector are prone to be liquidity constrained, not credit constrained, but liquidity constrained. And I see that in fact it's much even bigger effect. You see an even bigger effect. If you are a liquidity constrained, prone to be liquidity constrained sector activity, really, it's very important to have counter-cyclical monetary policy.
I think it would be very good to know to what extent the liquidity constraint differences across industries are more or less structural than those in terms of external financial dependence.
Yeah.
The reason is that if you think that the ranking or the quantitative differences are closer, let's say for liquidity constraints than for EFD, for external financial dependence, then you would have less measurement error for liquidity constraints, which might explain why the interaction coefficients are larger.
I see. That would be.
So some comparison of how structural
the differences are. That's a good idea.
Rank the size of these.
That's a good idea. Yeah. Now here you can say, well, it's strange because you took the period we took is 5 years before the euro and 5 years after. So you could say during the pre-euro period, countries were trying to converge in order to enter the euro. So let's restrict attention to the years after the euro, and in fact we find similar results as if over the whole period. So you want to make sure that you're not capturing this convergence process towards the eurozone. So now you might remember that I told you that you can decompose the auxiliary equation into a Taylor rule and a Phillips curve, and both of them have cyclicality thing. And you may want to say what is the effect of the cyclicality of the nominal short-term interest rate and the cyclicality of the inflation, which one is more important? And they are equally important because when you regress over financial dependence and the cyclicality of the inflation, you see, once you control for the interaction between financial dependence and the cyclicality of the real short-term interest rate, there is no additional effect of inflation. It means that inflation and nominal play the same role. They are equivalent. There is not inflation on top of the other one. There is only one instance, so that's when you interact with financial dependence or asset tangibility. When you regress on the real, there is nothing left for the nominal. And of course, when now you regress on the two components of the nominal, the Phillips curve and the Taylor rule, you see both of them are significant. You see, Both of them are important. The interaction of the cyclicality in terms of both, you see, I look at the interaction of the cyclicality in both things, you see, of this guy and this guy. And both are important, you see, equally important. So that's what I'm doing. Here. And now when I go to labor cost to sell and inventories to sell, I find the same result, except inventories to sell and inflation. There, inflation plays a bigger role than the cyclicality in nominal short-term interest rate. Why? Because when you have inventories, inflation affects the future values of the inventories. So the cyclicality in inflation plays a bigger role when for sectors that are inventories to sale ratio high than the nominal interest rate. But that's only with that measure, is because the value of inventories is affected by inflation. But when you lose the labor cost to sale measure, that's no longer true. You are back like before. The two components play a similar role. So that's the bootstrapping. So that's really the bootstrapping. I don't want to go into that. Other stories, remember that I had covariates, so the average private bond market to GDP, average short-term interest rate, average long-term interest rate, inflation, size of government, fiscal discipline, everything you want, you interact with asset tangibility, and whatever you do, you don't change the interaction between asset tangibility and real short-term interest rate. So that's and same here. I put all the covariates, and I have labor productivity. I look at the interaction with labor cost to sale and the cyclicality in real short-term interest rate. When you put all the covariates, the interaction between between the labor cost to sale as a measure of liquidity constraint and the cyclicality of monetary policy remains robust. Doesn't mean that the covariates don't matter, but if they matter through their effect on cyclicality of monetary policy. So that's what I do here. And here are instruments. Similarly, the share of Catholic in total population, religion, or as an instrument for the monetary policy cyclicality, and we find that it works. With all the faith you can put or not, even if it's religion, I don't know how much faith we can put into using a share of Catholics as an instrument. And the economic magnitude, now I do exactly the same exercise as I did for the fiscal. I look at by how much you will increase growth if you move from a lower quartile, credit constraint or liquidity constraint sector, and a lower quartile monetary policy cyclicality country to a higher quartile, credit or liquidity constraint with a higher quartile cyclicality of monetary policy. And the interesting thing is that where is it? You gain much more. The growth gains are bigger for the growth gains are bigger for the dependence with inventories to sale or labor cost to sale, because you get growth gains of between 2 and 3 over 3%, whereas you have lower gains. So really, the one that matters, maybe for the reason you mentioned, is the interaction with liquidity constraint and cyclicality of monetary policy. So that's an interesting thing that distinguishes monetary policy from fiscal policy. If you did the same exercise with fiscal policy counter-cyclicality, you would not find the same result. So, so now you can look at asymmetric effects, and you see that the effect here for monetary policy is similar in upturns, they're a bit bigger in upturns than in downturns. So there is not big, we didn't find much, it's a bit more significant, in downturns than in upturns. But the asymmetry was less pronounced than before. And the R&D, when we regress R&D, we find again that R&D responds a lot to the interaction between liquidity constraint and the cyclicality of the monetary policy. So that's...
Philippe, going back to the asymmetry again.
Yeah, the asymmetry here, you find not very significant. Yeah, that's right. The asymmetry.
Did you find a different level of asymmetry depending on the spread between the local bond and German bonds? Does this hold similarly for all types of risk?
We do cross-sector plus country, so we did not really, we could have separated for those who are further. That would be a nice thing to do, to see whether we get more of it for countries that are far away from Germany in terms of the cyclicality, or close to Germany in terms of the cyclicality for Eurozone.
Well, I was actually thinking about far away or close to Germany in the degree of sovereign risk. Does this be...
Okay. So that I haven't done. That would be something we could look at. So here we see that it's more significant in downturns than in upturns, but the asymmetry is not coming as strongly as it was for the fiscal policy. So the takeaway is stabilizing monetary policy legs long-run industry growth, the more so in industry, tighter financial or liquidity constraint. This growth is more significant in low states, a bit more significant in low states, and that's the main thing. So the view overall is that counter-cyclical fiscal monetary policy has a good effect. The takeaway from this research is to say, in fact, you see, what is the approach to recessions? For the moment, the debate is essentially between two extremes that I don't like. You have, on the one hand, the Keynesians who say, you know, when you have a recession, spend everywhere, and you get out. Maybe when you have a tough recession, that's what you should be doing. But essentially, there is a view: spend, and that's it, and that works. And they look at the short-run multiplier and demand effects. On the other hand, you have the neo-conservatives who said, you know, Cameron and the Republicans in the US, there are good Republicans, but I think of the Tea Party, whatever, and they say, you know, minimize tax anywhere, don't intervene, let things happen. And this is like what I call the smart state. It's neither the minimal state nor the Keynesian. I'm not demand side, I'm supply side. I say I want firms to be able to maintain R&D investment over the cycle. And what I want to do is to have a smart state who has balanced budget, who has tough monetary policy on average, so that we can conduct more counter-cyclical fiscal and monetary to be able to help firms maintain training expenses, R&D, and other things which are growth-enhancing expenses over the business cycle. That's the Swedish approach. That's Mr. Andersborg. Andersborg is not a Keynesian, but he's not Cameron either. And I believe very much in that. So this paper, this research, is to say between the Keynesian approach and the neo-conservative approach, you could call it the Schumpeterian approach or the smart state approach. It's supply side. I look at long-run growth and not just short-term activity. So I look at supply-side policy and I try to ask, what kind of policy can you do to maintain long-run growth? And I advocate counter-cyclical policies and at maintaining R&D and training and other policies over the business cycle. And I think that's what drives me. That's what I say. You know, when you do the adjustment towards public, you know, in public debt or public, use structural measures. Don't put sanction systems in a way that will make countries more pro-cyclical. Make sanction systems to maintain the counter-cyclicality, because that counter-cyclicality is a key macro ingredient to make sure that firms maintain R&D efforts over the business cycle. So you see, that's what I call the third way, or maybe because Tony Blair had the third way, let's call it the fourth way or the smart state way. But it's you see, that's the way, you know, that's the whole approach to macro policy, which is, I think, new, which is different from what was. That's why I want to conclude my presentation. Yes.
So you talked separately about the fiscal and monetary counter-cyclicality. Have you looked at the interaction between?
Yes, exactly. What's very interesting is that they are not substitute; they are complementary. When you have one, you can have. In fact, there is a picture there that I should show you. But we've done regression, that they are complementary. You have some countries that, whether equally among countries with low and high fiscal counter-cyclicality, you have a big effect on growth of more monetary counter-cyclicality. That's very interesting. They are complementary. You need both. It's not that because you have high fiscal, you will no longer need the monetary. You need both, actually. And let me show you 1 second, and I respond to your question. But just 1 second, let me show you a table. Which is a covariates. 1 second. That's no short-term cost of capital. Fiscal balance, exactly. So you see, these countries. I mean, it's true that you have a slight positive correlation between the cyclicality and the average government expenditure to the size of government. And it's true that you seem to have slightly less effect of the cyclicality in countries that have more fiscal balance. But in fact, you see, this is insignificant. In fact, when you look at the regression, you don't find any significant effect. The cyclicality of monetary policy matters almost to the same extent, whether you have high or low cyclicality of the fiscal policy. Yes. Yes. Yes.
You said you've been using before euro and after euro years. How much the cyclicality developed in eurozone within this period? Could you say split it and see whether the eurozone is more or less cyclical, both fiscal and
it tends to be
monetary,
more.
what does it mean for its growth potential vis-a-vis the rest of the
It
South?
tends to be less counter-cyclical than the rest of the world. It tends to be less. So that's a big challenge now. That's why I believe that one of the big challenges to enhance growth in the zone is to make it become more. But of course, you make it become more counter-cyclical also by having more discipline. You need the golden rule also, but also you need to balance the prices.
This is my thinking. Because there are also SGP and SGP minus or plus.
That's right.
It matters. But what does it mean empirically? Is it empirically significant? You see what I mean? Yeah, you calculated 1%.
Yeah, and
how
so I
much?
don't know.
You
will gain growth.
The
growth gain would be
loss of countercyclicality in euro.
In the eurozone, I mean, it's I don't have a clear figure, but it's a significant difference. But I don't have the figure with me, but I can bring you. I can send you the figure. That's the kind of thing I can. You see, that's one of the dark authors there. You can say, help. I need the. Yes.
Would it be correct to say that the results on the monetary policy, countercyclicality's effect, are even more important than those on the fiscal? Because potential weakness of that research design is that countries that have more countercyclical fiscal policies may also be better at directing their fiscal expansion.
Yeah, exactly. To sectors, to particular activities
that needed more.
Yeah. You raise an important issue there, which is to say that you may be afraid that countercyclical fiscal policy might translate into industrial policy and say you pick winners or not. Although you could have a way to do that says you have a small business act to say, I guarantee public procurement over the cycle. I guarantee. So if you do it this way, you don't pick. You see what I mean? You say, I take small and medium-sized firms, they have training and R&D activities, for example, and maintain them over the cycle. So that's a way to reduce. But you're right that there is a potential pitfall of the fiscal, is it that you may have still countries that select sectors bad, whereas the monetary has this great advantage that is on target. And absolutely, that might be a reason, and that's certainly an advantage. Yes?
Okay, you said that your approach is third or fourth phase, somewhere between neoconservatism and Keynesianism.
Yes.
But can I see this another way, that what you proved, that this countercyclical policy, just Keynesian one, is not only short-run, but also long-run policy. So I would view this as reinforcing Keynesian view, rather than something independent.
Yeah, but
from what you said. You got my point there.
Yeah, I mean,
just reinforcing Keynesian view, which works not only in short run, but in long run as well.
Yeah, but the Keynesian would not tell you that in good times you have to reduce. You see what I mean? The Keynesian would not tell you of the importance of reducing the average public debt. You see what I mean? The Keynesian would not do that. You see, they would not tell you to be. They would just tell you spend in. But it's true. Also, one thing you can also look is that you could look at the structure of spending, and it's true that I told you expenditure and revenues. When you look more into expenditure, it's more expenditure in investment. The cyclicality in government investment seems to be very important. So what this would tell you is that it would tell you that it's particularly important to maintain R&D and this kind of investment over the cycle. The Keynesian would tell you spend anywhere, you distribute wages, and that's it.
The Keynesian would not Keynes. Keynes would say balance.
Keynes would say, you see what I mean? And there you would say, no, focus on maintaining those growth-enhancing activities over the business cycle. You see what I mean? And that would be the difference with the Keynesian. The Keynesian will tell you, anything you spend on, those are wages distributed, and that's good. That would be a bit different. You would say, no, focus first on maintaining training and things. Of course, I believe, that's what I take from the Keynesian, it's good to have stabilizers also for wages, because if you have huge decrease in demand in recessions, of course it reduces the market size of innovators in recessions, and that's also bad for them. So there is something I keep from Keynes, is the fact that I want to have automatic stabilizers. Okay, that I keep from the Keynesians. But on the other hand, it goes through supply side here. You see, that's the whereas the Keynesian don't go through supply side.
I know, but this is addition, because they maintain countercyclicality of both policy, Keynesian view or new Keynesian view. You add only supply side of it. I don't think it's some third way.
No.
Just reinforcing in a sense. Okay, with some additional.
Yeah, but I would insist on having budget balance on average. Keynesians would not say anything on that, because I would say it's easier to be countercyclical when you when you are balanced, when you are more balanced on average. That's not something that Keynesians pushed for. I mean, you see that here I would say it's important. And I will insist on the smart state. You see, the Keynesian stance span anywhere. I believe that it's important to maintain certain kind of investments, particularly. That's not something that the Keynesians would tell you. You see what I mean? And they don't talk about credit constraints so much. So it's, I mean, it's not inconsistent, but it's like refining. And it's more like the smart state. I mean, at a very concrete level. In France, for example, in the Socialist Party in France, I advise Hollande a bit. There is the left of the left, okay? So Mrs. Aubry, who is a kind of classical Keynesian, they say span and that's it, okay? And you get out of it. The smart state would say no. Budget balance is very important. And take it, so it means that you cannot spend everywhere. You have to spend in some areas and not others. But you have to restore overall discipline. So there is a very different way of behaving. You see what I mean? You don't behave the same way. So now you could say it's true that we import some Keynesian elements in our theory, which is fine. But you see, we have the way to do policy is very different, because we say budget. We need we need to have budget balance to have a state that spends some in areas which are the growth enhancing at the expense of others. Whereas the Keynesians would not speak this way.
But you don't have a balanced budget all over the cycles.
Sorry?
You have balanced budget only on average, isn't it? Not all the time.
Yeah, that's right. But
still you
want to be under control. Yeah, but you don't want to have excessive. But still, that's why you would like the structural deficit, structural debt to be lower. So you would say that's what they did in Sweden. They reduced structural deficit. You see. That was a big part, because they realized there would be much more, they would have more flexibility there. That's not something that the Keynesians would insist upon so much. You don't see Krugman telling you every day, reduce, structural debt. That's not his obsession. I think it should be as much an obsession this than the counter-cyclical. So that in that sense, you see, it's not exactly the way. Yes?
You've got your empirical findings on the data 1982, 2005, or something like that, right? Which means that
1980, the fiscal is 1980, 2005.
Which means during the period of time when everything was more or less fine, there was a great moderation and so on. I would like to ask you,
what happened if I had after 2005?
I would be asking not only that, but how useful would be, or what is your policy recommendation for the current time, based with respect to what you said, what will happen if you would be using this, and also with the feasibility of this policy, monetary and fiscal.
Look, which country did well during the crisis? Look at which country did particularly well during this crisis? Sweden, the Scandinavians. They did very well. Germany did very well. They managed well. So, those countries who took these very strong rules, they also did things on banking regulation, because they got a big hit in the 1990s, so they learned their lesson. They know, and now we'll be careful with this. But they manage well. Those are countries that grow fast, that are disciplined, and that have also social justice. They know how to share the role. I always say, I believe in the triangle between budgetary discipline, growth policy, and social justice. I think this triangle works very well. And countries that implement it, they do well, actually. They manage very well in the current time. And they did very well, in particular, during this crisis. So I think that put them even more on the map.
And what's the way for these countries who didn't do it, and what they do now, what they should do now?
There are many countries who don't do it, and I don't know, Cameron should maybe learn a bit more from experience of... I know he invites Borg, but I don't know if he could, what he does when he invites him. I know he invited Martiez, I don't know. I think because the problem with the UK, for example, is that they say, okay, they have excessive deficit, we should have minimal state. So they cut spending and tax everywhere. So their reasoning is to say, you minimize tax, and you minimize spending. Because you minimize spending, your interest rate will go down. But the interest rates are very low already in the UK. You don't need to make them lower. And therefore firms will have low tax and low interest rate. They will hire a lot, and growth will resume. That's their view, but it's not working so far so well.